Hello, good morning. How are you? Kindly tell me, have you joined the WhatsApp group? Can you hear me? Okay, kindly tell me, have you joined the WhatsApp group? Okay, because I had to send the file for the sake of the practice. So that's why I was asking. I'm just sending you the file right now of the Word file, which contains the question for the IAS 16 as well. And today we will be covering the IFRS 16 leases as well. So I'm going to send you the questions right away, which we are going to use, and I am sending them to the WhatsApp group so that the other students who join can have the access to that question as well. And maximum by today, the evening, you guys are going to get the link for the notes as well. Basically, I had been compiling the notes because I had to update them according to some of the changes in the SBR, but I was kind of a bit busy. Yeah, you will get the notes for the first 2 days as well. I am making an like the link to the Google Drive as well. I will be uploading my all the stuff related to what's been covered in the all the lectures basically. So when you are going to have the set for the SPR, you will have the notes as well for those the previous two classes as well. Okay, I've sent the notes as well. Now let me just share the screen as well for the notes which I've just sent. Here we go. And, okay, basically in our second lecture, we covered up the standards related to the tangible non-current assets, that is the IAS 16. Along with that, we covered up the IAS 20, that is the government grants, the 23, the borrowing costs. Along with that, we covered a bit of a portion for the IFRS 5 as well. So that was a comprehensive revision for all the standards that we have already studied as far as the FR paper is concerned, or our financial reporting, the prerequisite for the SBR is concerned. Tell me about yourself if you have joined today. Have you studied the FR, or you had the exemption because of your some other degree or something?
Yes, good morning. So I have got exemption from my degree, Bachelor
Okay.
of Commerce, Accounting and Finance.
Okay. And you did your bachelor's from the University of Mauritius?
Excuse me?
You did your bachelor's from University of Mauritius?
No, 13 University of Mauritius.
Okay. Okay.
Yeah.
No problem. The thing is, basically, I'm hoping that you must have covered up the basic standards as far as the IS
So, good
16 is
morning,
concerned.
everyone. Welcome to all of you.
So,
Apart from that, you must have covered up some of the standards related to the tangible non-current assets, then the intangible assets as well. So I'm kind of,
yes.
yeah, I'm kind of hoping that you must have studied those as well. So it's not a like big issue for now. I mean, you can go through the lectures as well, and you can always ask me onto the WhatsApp group as well regarding when you are covering up and when you are revising your standard and you come across any problem or something, you can consult me over there as well. Plus, these questions are kind of like, for the sake of the practice as well, because as far as the SBR paper is concerned, this paper is more about the explanation. They're more about understanding of the standard rather than going for the number crunching and all. Because in SBR, rather than going for the computation and everything, apart from that, we have to explain our understanding regarding the standard. So this is something we will be looking over here today as well. And then after covering up the lease standard, that is something we will be, covering again. And basically, we will be discussing about the approach that we should have as far as this paper SBR is concerned. So I guess the other students will join in a bit. I mean, normally they do join by this time. Let's see till when they join. And anyhow, without wasting any time, let's just start. We have this question, and the first one is basically on 1st September 20x7, Blochberger purchased a new machine for use in its factory. The directors have capitalized the purchase price, but are unsure how to treat the following related costs. 400,000 was spent on testing whether the machine was functioning properly. During the testing period, that is September to October 2007, samples were produced and sold for a total of 75,000. 300,000 was also spent on training existing employees on how to operate the new machine. The machine is being used to manufacture a new product, product C, and 1 million was spent of advertising this product. Testing was completed and commercial production of the product C commenced on 31st October 2007. Now, the requirement is advice of Blochberger on how the above transactions should be dealt within its financial statements for the year ended 31st December 2007. Uh, Talking about these over here, I mean, if we talk about the transactions, we can say, or basically the amounts that we have seen over here. One is basically the directors were kind of show. So they capitalized the cost as far as the purchase was concerned, or the purchase price was concerned. Now we have three things over here. One is this 400,000 spent on testing. Then during the testing period, the samples we produced, they were sold for a total of 75,000. So this is the point relating to the testing as well. Then we have this 300,000, which is spent on training the employees. And then when we got this machine, we were producing a new product. So we spent this 1 million as far as for the advertisement of the new product is concerned. So this question is explicitly dealing with the cost half, that is the initial measurement of a non-current or a tangible non-current asset. So these are the stuffs which we have seen, and these are the stuff about which the question is asking, that how to deal with these all points basically that we have over here. Now, talking about if it would have been the paper FR, the question would have been that show at what amount the machine should be capitalized at, or at what amount the machine will be capitalized and then depreciated. I mean, if it would have been the level of FR, that is the financial reporting. But as we are into the SBR, now look how the question has changed, and it started off with this word being called as advice. Now it's asking for the advice that we have to tell that how we are supposed to treat these figures which are given to us over here. Now, whenever we come across a question related to a specific standard, we don't go straight away answering the the issue which has been given to us within the question. Whenever we come across a question, and especially this SBR paper, we are not going to straight away answer what is being asked from us, because this is about the discussion. So we can't go straight away about saying that you should do this and that with this and that's it. I mean, no, this should not be the approach. The best approach, the first thing which you have to do is to, let me just write it down over here on the next page. The approach towards answering the question should be, number one, first of all, tell about what the accounting standard related to. First of all, you have to tell about what the accounting standard is related to. What are the initial, or what is the rather initial criteria for recognition in the standard? What is the initial criteria for recognizing or recognition in the standard? Then take up the problems one by one and address them. Then you have to go and you have to take up the problem, and then you have to address them. This is what your approach should be. And this approach should be applied even if there are 5 to 6 parts in a question. For example, if I go back over here, I have mentioned these as question number 1, 2, and 3. Whereas these questions are basically from a 25 marks to one single question. These 3 questions are a part of one single question of 25 marks each. Done. But I've segregated them over here so that you can come and then you can apply your approach towards each and every question separately. But even if it's given in the parts, what you have to do is basically you have to explain about the standard, you have to explain about the initial measurement criteria and all, and then you will go towards as far as addressing each and every aspect that has been given to you. Now, talking about this, as we have read about the problem that over here we purchased a machine and we have capitalized the purchase cost, but now for the other costs we are unsure. Now, what should be the approach? We should start off our questions answer by saying that IAS 16 property, plant, and equipment deals with the tangible non-current assets, right? We are going to start it with IAS 16, property, plant, and equipment, deals with the tangible non-current assets, and it has its own recognition criteria when it comes towards the capitalization of costs. IAS 16 defines the cost as all the expenses being incurred in bringing the item of non-current asset to its present location, condition, and expenses incurred so as to bring it to its intended use. So, any costs that are directly attributable to bringing the asset to its location, condition, and necessary for it to capable of being operating in a manner intended by the management should be capitalized. Then this is what your approach is going to be, where you started off by defining the standard, that what the standard deals with, what the recognition criteria is. I mean, I just gave you the definition of the cost, that all the expenses being incurred in bringing the item of non-current asset to its present location, condition, and expenses incurred so as to bring it to its intended use. Then I talked about that this is the criteria of the standard, that we have to capitalize all the costs that are being incurred as far as bringing the asset to its intended use is concerned, or as far as bringing it to into a manner which is intended by the management as far as for its use is concerned. Now, after defining the standard, now we will go towards what has been asked. Now, this 400 was spent on testing. We will start off by saying testing of the machine is to ensure that it is functioning properly as required before the machine can be used into the commercial production, right? We are going to start off by saying that what's the testing cost? We have to define that as well over here. That testing of the machine is to ensure that it is functioning properly as required before the machine can be used in commercial production. Therefore, under IAS 16, the now we can say as the company, or we can say it by the name, as we can say that so under IAS 16, the Blochberger, or we can say the management, or we can say the directors should, right? This is how basically you have to address. This is how basically you have to address, either by saying the company, either by saying the directors, either by saying the name of the company, that is the Blochberger, that the Blochberger should capitalize this testing cost. The Blochberger should capitalize this testing cost of 400,000. Done. And then we'll say that, however, the samples, they were sold for 75,000. Therefore, the net cost of 325,000 should be capitalized, being the 400,000 cost of testing the asset's functionality, less the net proceeds of 75,000 from selling the items produced while bringing the asset to its required location and condition, or while bringing the asset to its intended use. See how basically I am explaining. At times while explaining, we might feel that this is very basic. I mean, the examiner would have known about this, that what we are saying about defining each and every aspect of the standard. Normally, at times it can come into our mind, or it might light a bulb in our mind, that this is very basic. I mean, why are we discussing these such basic things and all? When we ask this question, the answer to this is simple, that it has asked for the advice, because if it is so basic, the directors should have known it. I mean, why the directors are asking for your advice about what to do this testing cost? Getting my point? So this is what the approach is going to be about, the answer. Now, we have discussed this point where we talked about a net 325,000 should be capitalized, and then we gave up the breakup, that the 400 of this thousand is basically the amount of the cost of the testing the assets functionality, less the net proceeds of 75,000 from selling the items while bringing the asset to its intended use. Now, by this, we have given the explanation and the recognition criteria under the standard that any proceeds that you get from the samples that you have produced are going to be netted off from the cost of the testing. Now, coming towards this 300,000 which is spent on the training existing employees. This 300,000 spent on training of the existing employees. While talking about the training, one thing is for sure, you can say that the training cost of 300,000 must be expensed in the profit and loss, as they are not considered a direct cost. Or we can say that the training cost of 300,000 must be expensed to the income statement or the profit and loss as incurred, because it does not meet the capitalization criteria of an asset. Now, here you can add up an explanation in your answer that why you are saying that the training cost doesn't meet the capitalization criteria. Here, you can say that the training is an intangible asset of the employees. And while talking about the intangible assets, it has, it has its own add-on recognition criteria, and that is the capability of being separable and sold separately. Now, we cannot separate the training from the employees. The training is not separable from the employees. Therefore, it does not meet the recognition criteria. Therefore, the 300,000 cost spent on training the employees or training the existing employees will straight away be charged to the profit and loss account as incurred, right? Why we are not capitalizing the training? Because although this is the cost that we have to incur as far as bringing the machine to intended use is concerned, normally this is what we think. But as we discussed last time as well, the machine is ready for use. It is our employees who need the training on how to use the machine. I mean, if you are a trained person, you will straight away go and you will start operating the machine because the machine is available for use. It is your employees who need to learn on how to use the machine. And then, secondly, speaking, the training itself, I mean, is an intangible asset and it's not inseparable. I mean, you cannot separate the training from the employees. I mean, as I always say, the training is not something like, a cap, a hat, or a laptop that if I am like, wearing it today, I'm the trained person. If I go back home, I take it off and the next person comes in and he wears it up and then he's trained or something. It's not the case. I mean, look at your own self, or let's just talk about your own self. The knowledge, the experience that you have is because of what you are working at, whatever organization you're working, right? I mean, if we take away your experience, your knowledge, do you think that you will be able to work in the same organization in the same position that you're working currently? No. And secondly, your own training cannot be separable. I mean, no one can take away your training, your experience from you. I mean, if you were doing some job some years back before the current job, if you're doing, I mean, let's just say, or let's just talk about that as well. Did you forget about the experiences of the trainings that you got from the other previous job? That previous experience would have definitely helped you over here in this current job as well, right? I mean, talking about myself, I've been teaching since 2005. It's been kind of like 17 years now, and more than 17 years rather. And this is something which I am kind of still enjoying day by day. I'm getting like, the more experience, the new experience, the new ideas, even about explaining the points is concerned. So I'm kind of like, refining myself day by day with the help of my experience and knowledge. So this is inseparable, so we cannot record it. So this is what you are going to explain over here, that does not meet the capitalization criteria of being called as an asset. And as being an intangible asset, it does not have the capability of being separable and stored separately. Therefore, it cannot be capitalized. And then we will move towards the third point, and that is 1 million was spent on advertising this new product. Now, talking about this 1 million, 1 million spent on the advertising, we can say that the 1 million advertising cost of the new product manufactured by the new machine must also be treated as an expense. Now, we said this advertising cost of the new machine, sorry, of the new product, that is a product C, being manufactured by this new machine, will be treated as an expense as well. Now, we are going to talk about, this reason. And the reason is basically the IS 16 specifically prohibits the capitalizing the costs of introducing a new product or service. I mean, technically speaking, we don't capitalize the advertisement costs and all, because these are the costs which are basically directly associated with the growing of the business itself, right? And then we are going to say that under IS 16, depreciation should begin when the asset is available for use, i.e., when it is in the location and condition necessary for it to be capable of operating in the manner intended by the management. Therefore, the depreciation of the new machine should begin. I mean, when we look over here that the machine is ready on the 31st October now, so we can say that the depreciation of the new machine should begin from 31st October 20x7 when functionality test is completed and commercial production begins, right? And then we can add in a point as well over here that then for the year ended 31st December 20x7, we will be charging the depreciation on this machine for 2 months. That is November and December. I mean, we can add up a point, we can add on a point over here as well. So this is what I am going to expect your approach as far as the explanation is concerned, as far as talking about this asset is concerned. This is what the approach you should have as far as answering the the question related to the advice is concerned, for whatever the standard it might be, for whatever the standard it might be as of, you have to give your explanation according to uh, by explaining each and every aspect of the standard basically. Done. So this is basically what we had in this question. Now let's just go towards the second question, and that is the Verge company. And talking about this Verge company, I mean, let's just see it over here. That is Verge, a limited liability company, was given a building by a private individual in February 20x2. The benefactor included a condition that it must be brought into use as a train museum in the interest of the local community, or the asset or a sum equivalent to the fair value of the asset must be returned. That is, you have to, the benefactor who gave the building as a donation to the Verge company made a condition that this building is only going to be used as a train museum in the interest of the local community. Otherwise, the asset or a sum equivalent to the fair value of the asset is to be returned to the benefactor. Then, getting my point, this is the first half of the question, that the building is solely been given for to be used as a museum. Otherwise, you will have to return the asset. Otherwise, you will have to return the building, or you will have to return the fair value of the building at the particular time, right? Now, the fair value of the asset was 1.5 million in February 20x2 when we got that building. Verge took possession of the building in May 20x2. Okay. However, it could not utilize the building in accordance with the condition until February 20x3, as the building needed some refurbishment and adaptation, and in order to fulfill the condition, Verge spent 1 million on refurbishment and adaptation. Now, advise Verge on how the above accounting issues should be dealt within its financial statements for the year ending 31st March 20x2. Okay. So we got this building in February 20x2. Our year end is immediately after a month, and that is in March. And then we were able to complete the building almost by the end of the next year. Almost by the end of the next year. So we are standing at this year end, and the building was eventually, like, being able to be used in the next year. And now we have to talk about these situations. Now, look, again, it has asked for the advice. You have to tell that what should be done as far as the accounting complications are concerned for this particular non-current asset. Now, the things, the condition, we have seen the benefit included a condition. This is the point. And the fair value of the asset was at 1.5 million in 20H2, and we spent this 1 million on refurbishment and adaptation. We spent 1 million on the refurbishment and adaptation. Now coming towards the answer, what can be done or what can we write over here again? We can start off by saying that, again, I told you earlier that even if we have around 5 to 6 parts of a question, what should be the approach towards answering? Tell about the accounting standard related to what is the initial criteria, and then take up the problem one by one and address them. Done? So by looking over here, this is again the one related to the non-current asset. So we can just say by saying that applicable standard here is again IAS 16, property, plant, and equipment. Within the framework of the IAS 1, that is the presentation of financial statements. And then we are going to say that IAS 1 requires that all item of income and expenses recognized in a period should be included in the profit and loss for the period unless a standard or interpretation requires or permits a different treatment. Now, IAS 16 states that the cost of an item of property, plant, and equipment should be recognized when two conditions have been met. When two conditions have been met or two conditions have been fulfilled. That is, it is probable that the future economic benefit associated with the item will flow to the entity and the cost of the item can be measured reliably. I mean, these are the ones that because of which we capitalize the initial criteria of the cost, basically. So these conditions are normally met or fulfilled when the risks and rewards have been transferred to the entity. And they may be assumed to transfer when the contract is unconditional and irrevocable. Now, talking about this particular scenario, which we have seen over here, the year end is 31st March 20x2. We got the machine, sorry, we got the building in February 20x2. But if we see over here, and we can see this point over here that it could not utilize the building till in accordance with the conditions until February 20x3 the next year, right? So we were not able to utilize the building in the same conditions or the expected conditions which were asked from us. So we can say over here, as at by 31st March 20x2, the condition of use has not been complied with the verge, with the benefactor, and the verge has not taken the possession of the building as well. The verge has not taken the possession of the building. The building may, however, be recognized in the year ended 31st March 20x3, not in 20x2, as the conditions of the donation were met in February 20x3, right? Why the conditions of the donations are met? Because it's written over here until February 2023, as the building needed some refurbishment and adaptation in order to fulfill the condition. So we completed off the conditions of using the building in February 2023, the next year, not in the current year end. We met those conditions by spending the 1 million. Only then we were able to, use it. Now, we can say over here by saying that the fair value of the building, this is 1.5 million over here. The fair value of the building of 1.5 million must be recognized as income in the profit and loss, for the year, as it was a gift. Now we received a gift, therefore it will be recorded as an income, right? This is the gift that we received. Yeah? And then the refurbishment and adaptation cost must also be included as a part of the cost of the asset in the statement of financial position, because according to IAS 16, the costs includes the directly attributable cost of bringing the asset to the location and condition necessary for it to be capable of operating in a manner intended by the management, right? So this is what you have to do now. And the necessary accounting entries, if you say over here, can be debit the building with a total of this 1.5 million and 1 million. The total is going to be 2.5 million. Then we are going to credit the profit and loss account with 1.5 million, and we are going to credit the cash with 1 million, which is being spent in order to, refurbishment of the refurbishment of the building, basically. Now, again, after capitalizing the building, we are going to say that in addition, the building would be depreciated in accordance with the entity's accounting policy, which could involve time apportionment over a 2 months, that is the February and the March for the 28th, depending on when in February the building came into use as a museum. Done. Now, if you look over here, this was the advice, and it was related to 31st March 20x2. And then we started off by saying that as far as the 20x2 is concerned, we cannot record the building as the conditions related to the use of the buildings were not met, right? So we started off by introducing the standard, the recognition criteria and all. We started off by saying as far as the 20x2 is concerned, we cannot record anything in the accounts. I mean, technically speaking, as far as the reporting is concerned, we could have stopped right over there. That in 20x2, nothing can be recorded in the accounts because the activities or the intended use of the building was not achieved. And technically speaking, the conditions to use the machines were not met as well. So we couldn't record anything. So as far as the reporting mechanism is concerned, or the paper, again, the FR is concerned, the financial reporting, the previous one, we could have stopped right over there. But in SBR, this is about the advice. This is about the explanation. So that's why we explained regarding the next year as well that, okay, for this year, you cannot record anything. But when the next year comes in, when the conditions are met, then what you can do? See, this is what the approach is now. This is what the approach is now. That rather than going for a simple double entry or something, or a simple recognition of the asset in the accounts, we are now discussing the standard. We are now discussing the standard. This is what is now required. And this is something which you guys cannot get in an overnight. I mean, this is something you can have with the help of the practice only, right? And to be honest with you, one thing is for sure that you have to, study the textbook as well along with the notes. A comprehensive and a good study is going to help you a lot as far as these discussions or the discussion parts of the questions concerned. I mean, I've already forwarded the book and the exam kit. I hope you guys must have it by now. And even if you don't, you will definitely get. I mean, I am in, like, continuous coordination with the coordinator as well, because as I discussed earlier, that I've been updating my notes, because of which you would not been able to get, and I was kind of like, I had a very hectic week, like, before, because of, like, some of the commitments at the office as well, because of the year end getting near as well. So the year end was here, and the accounts, like, the work was over here a bit, like, hectic. So that's why I couldn't get the time. But now I am almost into the final stages. So technically by the evening or tomorrow, you will have the SBR set one as well. So the thing which again I'm going to stress over here is that you need to read about, like, the standard as far as in the book or as far as in the notes is concerned. This is going to help you a lot as far as this explanation part is concerned. Done. And then we have this third question with you, and let's just see this question as well, how this question unfolds itself, and let's just talk about this as well. Now, Minker acquired a property for 4 million and annual depreciation of 300 is charged on straight line basis. Now, the first point over here, that we acquired a property and annual depreciation is 300,000 on the property. At the end of the previous financial year of 31st May 2013, when accumulated depreciation was 1 million, a further amount relating to an impairment loss of 350,000 was recognized, which resulted in property being valued at its estimated value in use. Okay. So basically, what happened that in the year ended 31st May 2013, when the accumulated depreciation was 1 million, impairment loss of 350,000 was recognized, which was because the property was then valued at the value in use. That is now the standard IS 36 over here. Now, just before continuing ahead and all, let's just write some stuff over here. Cost is 4 million. Annual depreciation is 300,000. Now, when the accumulated depreciation was 1 million, so it means cost minus accumulated depreciation is equal to carrying value. So when 4 million minus 1 million, when the carrying value was 3 million, we charged impairment loss of 350,000. So carrying value now is 3 million minus 350,000, that is 2,650,000. Done. Now this is what the carrying value we have right over here, and this is value in use. See, this is the 3 million we had when 1 million accumulated depreciation was charged, so carrying value was 3 million. We charged an impairment loss of 350,000. So now basically the carrying value at which the machine is reported is 3 million minus 350,000, that is 2,650,000, that is the value in use. Now, on 1st October 2013, as a consequence of a proposed move to new premises, the property was classified as held for sale. At the time of classification as held for sale, the fair value less cost to sell were 2.4 million. Now you have classified it as held for sale, that is IFRS 5. At the date of the published interim financial statements, 1st December 2013, the property had improved and the fair value less cost to sell was reassessed at 2.52 million. The property was reassessed at 2.52 million. And then at the year ended 31st May 2014, it had improved even further so that the fair value less cost to sell was 2.95 million. Okay. The property was sold on 5th June for 3 million. The property was then sold for 3 million. Done? Now, discuss how the above items should be dealt within the financial statements of Minco. Talking about this, if we see over here, we have two standards over here. One is the IS 16 property, plant and equipment. And one is basically the IFRS 5, that is the non-current assets held for sale and discontinued operations. And talking about then, as far as there's an additional point over here, which we will be discussing later in our course, is basically, let's just highlight it with the red. And this is the interim financial statements, basically. And the standard for the interim financial statements is IS 34, basically. So we had our interim accounts, and interim accounts, basically, the property's value was increased to 2.52 million. So this is something we have to account for as well. And as far as the internal financial statements are concerned, I mean, the one which you produce like on, after the 6 months of the year, or when the 6 months are kind of left, the quarterly reporting or 6 monthly reporting, you can call to the internal financial statements as well. The concept is obviously the same. I mean, you apply the same accounting policies in the internal financial statements as applied in the annual financial statements, right? So this is something we can start off by saying that IS 34, interim financial reporting, requires an entity to apply the same accounting policies in the interim financial statements as are applied in its annual financial statements. So my event should be based on a year-to-date basis, basically. So in valuing this property, the company should use the IFRS 5, assets held for sale and discontinued operations. Now, the rule for accounting the asset at the IFRS 5, the rule is very interesting. Like, whenever we look at revaluing the property, reassessing its value or something, there is one common rule which we come across at all the times. That is, the day when we decide to revalue the asset, we need to have the carrying value on that particular date. I mean, if we want to do the revaluation of the asset, the date when the fair value is given, we have to calculate the carrying value on that particular date. When we have to charge the impairment, we have to calculate the carrying value of the asset on the same date on which the impairment is given. Similarly, now in IFRS 5 as well, when we have to value the property according to the provisions of IFRS 5, that is the asset held for sale, we have to calculate the carrying value or the carrying amount of the asset on that exact date, right? So we can say simply by saying over here that the company should use the provisions of IFRS 5, assets held for sale. The carrying amount must be measured in accordance with the applicable accounting standards. So after classification as held for sale, the property must be measured at the lower of carrying amount and fair value less cost to sell. Obviously, in IFRS 5, we have to value the asset at the lower amount, right? We have to value the asset at the lower amount because this is what the rule of the IFRS 5 is. Like in IS2 inventory, we measure the inventory at the lower of its cost or NRV. So the same concept is kind of applied onto the assets held for sale, that we have to measure them at the lower of carrying value, or the net disposal proceeds, basically. Done. So we can start off by saying that impairment must be considered both at the time of classification as held for sale and subsequently in accordance with the applicable standard. Now, talking about this impairment point that we had, this impairment loss, we have to, like, guide, or we have to explain that any impairment loss recognized in the profit and loss should be sorry, any impairment which is any impairment expense is going to be charged into the profit and loss account, provided the asset has previously been revalued under IAS 16, in which case the impairment is treated as a revaluation decrease. See, in this one or two lines, we straight away explain that what is the criteria for recording as far as the impairment is concerned. Done. And then we are going to again explain about the point that any gain in the subsequent any subsequent increase in the fair value less cost to sell of an asset is recognized in the profit and loss account to the extent that it is the reversal of the actual impairment being charged in the accounts. Done. And that is the actual impairment charge in the accounts. So at the time of the classification, now we have to calculate the carrying amount of the property, basically this. Done. So at the time of classification, now we have to calculate the carrying value. And if you look over here, it says our year end is 31st May 2013. Done. And in May 2013, we have this value. So this value, technically speaking, 2650 is in May 2013. Now, on 1st October, we are going to classify it as held for sale. Now, on 1st October, we are classifying it as held for sale. So technically, June, July, August, September. June, July, August, September. 4 months have passed, right? So ideally speaking, what should we do? We should charge the 4 months, what do we say, as the depreciation as well, right? We have to charge the depreciation for these 4 months as well. Now, talking about this, we had an annual depreciation on the property at 300,000. So technically speaking, this 300,000 by 4 million, what is the depreciation charge? Let's just calculate the rate or something in order to get an idea. So 300 by 4,000, I get around 7.5%. I mean, I don't have the number of years. So let's just say that my depreciation charge is like around 7.5%. So now the carrying value is at 2650. So 2650 into 7.5% into, I had the property 31st May is the year end. So June, July, August, and September. Because on 1st October we are doing it. So 4 months have passed. So I'm going to do this 4 by 12. So I get 2650 into 7.5 into 4 by 12. I get a depreciation charge of 66 to 50 now. So this 66 to 50 is the depreciation charge for 4 months to 1st October 2022. To be now, this is the carrying value at the start of the year, 2650000 minus 66,250. I get 2583750. So this is what value basically I get over here, and this is 2583750. Done. Now what we can do over here, that at the time of classification as held for sale, the fair value less cost to sell was 2.4 million. I'm sorry, I got disconnected. Okay, so as I was saying, that I have a carrying value over here at 2.58 million, whereas the fair value less cost to sell is at 2.4 million. So technically speaking, we have to measure it at 2.4 million. So initially, the written down on the classification on held for sale is 2.58 minus 2.4 is, what do we have this as? 0.18 million. So the initial written down is going to be at 0.18 million, we can say, or rather, and then we can again say that the property is now carried at 2.4 million. Then on 1st December 2013, as a consequence of the proposal of the new premises, okay, we got this over here. Sorry, on the interim financial statements, 1st December 2013, the cost to sell was reassessed at 2.52. Now at 1st December, the property is reassessed at 2.52 million. Now the property is assessed at 2.52 million. Done. So we can simply say that on 1st December 2013 in the entire financial statements, the property has been improved, and the fair value less cost of sale is now standing at 2.452 million. Done. So we can say that as this is the gain now, and if we compare it with the 2.4 million, the gain on the property is now at 2.52 million minus 2.4 million. We have 120,000 gain. Done. Whereas this is at 180,000. Done. This is the loss which we have recorded, or this is the impairment we can say as well, when we write down the asset at the lower of the fair value or cost of sale. Now, so this is the 180 which has been charged in the statement of comprehensive income while writing down or bringing down the assets value as so as to record it for the held for sale. So we have recorded this 180,000 in the profit and loss account. Now by 1st December, the property's value has increased. We have a gain of this 120,000. So what should we do? The gain of this 120,000 will be credited to the profit and loss account, because this is going to reverse this loss. So technically we can debit property held for sale by 120,000, credit profit and loss account with 120,000. Done. So this is the double entry that we can pass over here for now, because our property has increased, and this gain is going to be recorded in the profit and loss as an income, obviously, but this will be a kind of sort of a reversal of the previous written down that we had when we classified the property at the held for sale. Done. And then accordingly on 31st May 2014, now this over here, the year end, the property has improved further to 2.95 million. The property has improved further at 2.95 million. Therefore, the further gain which we have to record is now going to be calculated over here. And basically, we are going to calculate now again that what is the total gain which we have which we have got now. Now at this was 31st May 2014. 31st May 2014, the property value increased to 2.95 million. New gain now is 2.95 million minus 2.52 is 2.95 minus 2.52 is at 430,000. Now the gain is at 430,000. Done. Now the gain is at 430,000, but this is now a problem over here with us as well. That is, actual impairment charge in accounts. If I come over here, we had actual impairment charge of 350,000, right? Actual impairment charge in accounts was 350,000, remember? And technically speaking, then we recorded the lower written down value, this 180,000 plus 180,000. So the actual impairment charge is 350,000, written down value due to held for sale is 180,000. Total written down is 350 plus 180. Let me just show you what I'm doing. 350 plus 180 is 368. Not 368. I'm sorry. This is 350 plus reversal by first increase in value is 120,000. Remaining impairment loss is 530,000 minus 120,000. 410. Done. Now, remaining impairment loss with us is basically at 410,000, whereas we have the gain of 430,000. This is what I was trying to calculate, this figure, that the loss total remaining in the profit and loss account in the name of the impairment or the written down that we had is basically 410,000, whereas now we have a gain of 430,000 with us. So what do we have to do is, or what we can do now over here is we can only restrict the gain to 410,000, because the rule of the reversal of the impairment of the loss is that we can only credit it to the income statement up to the extent the loss has been recognized, right? We can only reverse it into the accounts up to the extent the loss had been previously recognized. So in this case, as we have calculated over here, our loss is kind of, or our reversal is kind of going to be limited up to this value only. So our gain is at 430,000, but we can only reset it to 410,000. Therefore, we can right now, we will have to restrict the gain to 410,000, and it will be credited in the profit and loss account as the property is now carried at 2.95 million. Then we can say that the gain will be restricted to 410,000 as this totally reversed the impairment loss in the accounts, and then the property is going to be valued to 2.95 million. Subsequently, when we have sold the property, and when we have sold the property for what, 3 million, the gain will be going to be recorded in the accounts. And as the property is sold for 3 millions, we are going to record the balancing of the gain. And as the property has been sold by, like, after the year end, therefore it will not be adjusted in the current accounts, but in the coming year or in the next year it will be adjusted in the accounts. Done. So this is what basically we have to do. As far as this third part was concerned, we had to do a bit of calculations as far as the recognition of the impairment loss and then the reversal of the impairment loss is concerned. So that's why this was a bit tricky, but I hope you must have gotten the idea that what I wanted to share. And if any one of you have any question or something, you guys can ask me. Otherwise, we are good to go. I mean, if there is any question, related to what I have done the calculations over here or something, you guys can ask me. Otherwise, we are good to go as far as going ahead for our next topic is concerned. Any questions or something you guys want to ask? Hurry up, tell me in the chat box so that I can have an idea and then I can move. Guys, I'm waiting. Okay, it's all good. Okay, so these were the questions basically we had for as far as the practice for our previous or as far as the revision of the previous topics was concerned. Now we will have the leases, but for this first we have to do our standard. Let me just open our notes and then we will move forward towards the standard as far as the standard is concerned. Just give me a minute and then we'll resume. I just need a minute only. Okay, I'm back. So this standard that we have today is the IFRS 16 leases. And as far as this standard is concerned, this is something which is already covered in the paper FR as well. But we will be covering it over here comprehensively because this is a standard which is somehow someway covered in the FR as well. But there are lots of aspects that we have to cover, or lots of the the corners of the standard that we have to cover as far as the paper SBR is concerned, because there are very small technical points in it that we have to keep in our mind. Although as far as the working for the computational working is concerned, it's really very simple and it's not very complicated. And this is something that we can easily understand. So as far as the workings are concerned for the standards, easy, quite easy. I mean, the rules are always the same as far as for the accounting is concerned. But as far as the theoretical aspect is concerned, because we have to discuss about the standard at the end of the day as well. So that is a bit tricky, which we are going to cover up over here. Now, this IFRS 16 leases basically prescribes the recognition, measurement, presentation, and disclosures for the leases, with the objective of ensuring that the lessees and the lessors provide relevant information that faithfully represent those transactions. The standard, the scope is basically it applies to leases, including the subleases as well, except for the leases for the explorer or for the use of minerals, oil, natural gas. Similarly, the lease for the biological assets, the lease for the intellectual property, and the rights held by a lessee and the licensing agreements, basically, such as films, videos, plays, because we have the relevant standards to address those problems. Similarly, the first one, that is the lease to explore for the use of mineral oil, natural gas. That is something related to as far as the extraction of the natural resources is concerned. So these are all dealt with in their relevant standards. Now, having some key definitions that we have to see over here, and that is the interest rate implicit in the lease. This is something very common that you are always going to come across whenever the question of a lease is given. You will always have an interest rate implicit in the lease. Now, the interest rate that yields a present value of the lease payments, the unguaranteed residual value equal to the sum of the fair value of the underlying asset plus any additional direct costs to the lessor. So this is what basically the interest rate is going to be. The interest rate implicit in the lease is basically the interest rate that is prevailing in the market at the time when you get the lease. I mean, in technical terms or in simple terms, if we say. And if we talk about the definition is basically the interest rate which is going to calculate the present value of the future lease payments. The present value, which calculates the present value of the future lease payments. And that present value is more or less equal to the fair value of the asset. That is what we are going to call it as the interest rate implicit in the lease. Done. And the lease term is basically the non-cancelable period for which the lessee has the right to use an underlying asset. This is the non-cancelable period during which the lessee has the right to use the asset, plus periods covered by an extension option if exercise of that option by the lessee is reasonably certain, and periods covered by a termination option if the lessee is reasonably certain not to exercise that option. Now, the lease term basically is the time period over which the leased asset is going to be used by the lessee. And this lease term is going to be calculated as the normal time frame during which the asset is leased for, plus any extension period which it is reasonably certain or reasonably expected that the lessee is going to exercise that option, and the periods with the termination option. I mean, the period in which the lessee has the option to terminate the lease, that is going to be included in the lease term as well. Talking about this point, I'm going to write straight away over here regarding the explanation of this. I mean, for example, you lease an asset for 5 years. It is expected you will release the asset for further 2 years. And apart from that, you have 1 year of termination option as well, i.e. after use of 7 years of asset, you may avail 1 more year where you may cancel the lease at any time. Then the lease asset, you lease an asset for 5 years. It's expected that you will release for 2 more years, and then you have 1 more year as a termination option, option year where you may terminate the lease at any time, right? At now, talking about this, the lease term for this particular asset is going to be 5 plus 2 plus 1, that is 8 years. Why? Because the normal term is for 5 years, and it's expected that you are going to use the asset for further 2 years, and then after that you have 1 more year where you may cancel the asset termination. You may terminate the lease at any time, and it's reasonably certain that you are not going to terminate it. Now, if it's certain that you will terminate it, we will eliminate this 1 year from here. We will eliminate this 1 year from here. I mean, when you have the option to terminate and there are chances that you might terminate the lease, then you are not going to include that 1 year in the lease term. But if it is expected that you will continue to use the asset, then in that case, you will add this one over here as the life of the lease term, or the lease term, you will add it up over here into the lease term. Done. So this is the point basically I was talking about. Then we have the lessee's incremental borrowing rate. That is the rate of the interest that the lessee would have to pay to borrow over a similar term, and with a similar security, the funds necessary to obtain an asset of similar value to the right of use in a similar economic environment. Lessee's incremental borrowing rate is basically the interest rate that the lessee has to bear as far as talking about taking out a loan is concerned, the loan with the same amount, or the asset is concerned, the asset with the similar characteristics and all being leased out in the similar normal environment. I mean, basically, what the standard has covered this point over here is in this way, that whenever you lease an asset, the discount rate or basically the incremental rate of borrowing is going to be the one that you normally get, or the rate at which normally you get the loan, or from the bank. If you apply the loan, the interest rate with the banks puts on you is basically the one that is the incremental borrowing rate. Done. Now, talking about the lease and why this IFRS 16 is important. A lease is an agreement whereby the lessor conveys to the lessee the right to use an asset for an agreed period of time in exchange for consideration. Or talking about, we can say that a lease is an arrangement whereby the lessor allows the lessee to use the asset against a single or series of payments. Lessor is the legal owner of the asset. Lessee is basically the user of the asset. And a lease itself is an agreement between the two parties where the lessor allows the lessee to use its asset, right? And the time period is decided as well. The payment or the amount which will be paid by the lessee for the use of the asset is also decided as well. Now, before this IFRS 16, we had IAS 17 for the leases. We had IAS 17 for the leases, where we had two types of lease. One was the operating and one was the finance. And normally the finance leases were recorded in the accounts. We used to record an asset and then we used to record a corresponding liability in our accounts whenever the criteria for the finance lease was met. And if the criteria of the finance lease was not met, we used to classify the lease as an operating lease. But obviously, because of the loopholes and all, we had certain loopholes as far as for the recognition of the lease as a finance lease is concerned, because of which most of the businesses, they used to justify that the asset that they had leased is basically is of operating lease, and therefore they somehow some way avoided the liabilities to be shown in the statement of financial position. This is something they used to avoid, and they succeeded in avoiding that, like, by reporting the liabilities. So technically, because of the creative accounting and all, their accounts showed a healthier picture. So this was the problem basically. So that's why this was promoting an off-balance sheet financing, and off-balance sheet financing is basically not allowed, because if you have taken up a liability or something, that has to be shown in the accounts or something. So the IS 17 desperately needed a change. So therefore, the change came in back in 27 or 2018 something. I mean, this standard is not very old. This is the new one now. So now we have the IFRS 16. Talking about the IFRS 16 assets. IFRS 16 define a lease as a contract or a part of a contract that conveys the right or use right that conveys the right to use an asset for a period of time in exchange for consideration. In order for such a contract to exist, the user of the asset needs to have the right to obtain substantially all of the economic benefits from the use of the asset, and the right to direct the use of asset. Now, defining a lease as a contract, as a part of a contract where you have an arrangement of using the asset. I mean, this is very simple. The thing which we need to consider over here is the term when we say that the user of the asset have the right to use the asset. Now, this right of use asset is really very important now, because as far as the theoretical aspect is concerned, you are going to have the right of a use, of the asset when substantially all of the economic benefits are being transferred to you, or you get to get all the benefits from the asset related to you, and you have that exercise power on the right of use asset. Now, as far as for the recognition of the lease is concerned, we have 2 points. One, the asset which we have leased should be an identified asset. You should be able to identify the asset. The asset under consideration should be identifiable. Now, when we talk about an identified asset, the rule is simple, that an essential feature of a lease is that there is an identified asset. This normally takes place through the asset being specified in a contract or part of a contract. Now, the asset has to be specified, otherwise we cannot call it as a lease, right? A contract is or contain a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. And a control is conveyed where the customer has both the right to direct the identified assets use, and to obtain substantially all the economic benefits from the use. And then we have the definition for the asset, and then we have the capacity portion. and that is a capacity portion of an asset is still an identified asset if it is physically distinct. For example, the floor of a building. A capacity or other portion of an asset that is not physically distinct, that is the capacity portion of a fiber optic cable, is not an identified asset unless it represents a substantially all the capacity such that the customer obtains substantially all the economic benefits from the using the asset. So this is what basically identifying, and the capacity portion of the asset is really very important, that you should be able to identify that what the asset you are getting under the lease, and what is the going to be its capacity that you are going to use and all. I mean, let's just take an example of this identified asset with the context of the capacity as well, with context of the identification as well, because without the example you won't be able to understand what this whole discussion is about. Like, for example, under a contract between a local government authority and a private sector, p P provides local authority with 20 trucks to be used for refuse collection of behalf of local authority for a 6 years period. Basically, what's this happening? The local government has taken up or has hired 20 trucks from the private company that it is going to do the garbage collections and all for a 6 year period. The trucks which are owned by the private company are specified in the contract. Local government determines how they are used in the refuse collection process. When the trucks are not in use, they are kept at local government's premises. Local government can use the trucks for another purposes if it so chooses. If a particular truck needs to be serviced or repaired, private company is required to substitute a truck of the same type. Otherwise, and other than on default by the local government, the private company cannot retrieve the trucks during the 6 years period. Okay, so this is a 6 year long contract where the local government will be using the 20 trucks being hired from the private company, and those are going to be used for the refuse collection. And it is up to the local government to decide about on how to use the trucks, when to use the truck, and for what purpose the trucks are going to be used. And when they are not in use, they are kept in the premises of the local government as well. The private company is only required to change and provide with an alternate same truck if the truck is to be sent for the repair or something. The 20 original trucks which have been taken, if any one of those has to be sent for the repair work or something, then the replacement will be provided by the private company. Apart from that, if the local government defaults, only then the private company can retrieve the trucks that it has provided. Otherwise, for 6 years, the private company cannot have the trucks back. Now, conclusion basically. The contract is a lease. This is a lease contract. Why? Because the local government has the right to use the 20 trucks for 6 years, which are identified and explicitly specified in the contract. Once delivered to the local government, the trucks can be substituted only when they need to be serviced or repaired. So technically speaking, this is going to be a lease because you have identified the asset in the lease term. You have identified that what you are going to use, the quantity has been identified. Technically, the type has been identified as well, that which truck you are going to use. Now, and the same truck with the same specs and all is to be provided by the P when if any original truck has to be sent for the repairs or the service and all done. So this is going to be called as a lease because we have identified each and every aspect of the asset that is under consideration. Now, after identifying the asset, the next initial point that is really very crucial over here as well, and that is the right to direct the use of asset. Now, this is really very important and interesting one as well. IFRS 16 states that a customer has the right to direct the use of an identified asset if either the customer has the right to direct how and for what purpose the asset is used throughout its period of use, or the relevant decisions about use are predetermined and the customer has the right to operate the asset throughout the period of use without the supplier having the right to change these operating instructions. Now, we saw in the above example where you are getting 20 trucks, they will be used for refuse collection purposes. Local government is going to decide about how and when to use the trucks and for what purpose. So technically speaking, on the 20 trucks, the local government has the authority to direct the use of the asset. They have the authority about when to use, where to use, for what purpose to use. The private company, on the other hand, does not have any interference or something, right? So technically, that is a lease because the local government has the authority over the direct use or right to direct the asset as well. Now, look at this example. A customer C enters into a contract with a road hauler for the transportation of goods from London to Edinburgh on a specified truck. The truck is explicitly specified in the contract, and H does not have the substitution rights. The goods will occupy substantially all of the capacity of the truck. The contract specifies the goods to be transported on the truck and the dates of pickup and delivery. H operates and maintains the trucks and is responsible for the safe delivery of goods. C is prohibited from hiring another hauler to transport the goods or operating the truck itself. Now, C has entered into a contract with the road haulage company. It has explicitly identified that from London to Edinburgh, the goods will be transported. It has identified that what goods are going to be transported, and the delivery dates are the pickup and the delivery dates, they are being specified as well, or there are specific dates on which the pickup and the delivery will be done. And the customer, he cannot operate the truck itself, and he cannot hire any other company as well. Now, as far as this contract is concerned, this is not a lease. This is not a lease. Why? Let's just discuss this in in our general discussion, and then we'll go towards whatever the points are written over there. The first one is, although you have identified the asset, I mean, for what purpose the asset is going to use and all, everything is defined, but you do not have the right to direct the use of the asset. I mean, you have specifically identified what goods are going to be transported via the trucks. It means if you want to transport some other goods or something, you cannot, because the goods which you are planning to transport have been identified, that what goods are going to be transported. Point number one. Point number two, you have specific pickup and delivery dates. I mean, what if you want to send something apart from the pickup and delivery dates? Then what? You won't be able to do. Third point, apart from the hiring, the other services, all, we are not interested in that. But in this particular one, that you cannot operate the truck by yourself. The customer cannot operate the truck itself. So technically, it has to rely on that road haulage company for the operations of the truck, right? And we have identified what trucks we are going to use, but from those identification of the trucks and all, which trucks, I mean, if we say that we are going to use a 14-wheeler truck, I mean, we can specify that we are going to use a 14-wheeler truck, but which 14-wheeler trucks? I mean, there can be a category of the 14-wheelers as well, huh? So we have we are more interested as far as the capacity of the truck is concerned, not with the type and all, the truck is concerned as well. Now, if we see over here, there is an identified asset. The truck is specifically specified in the contract, and NH does not have the right to substitute that specific truck. Fine. This one is clearly written over here that we have specified the truck, and H cannot replace the trucks. But which trucks? This question comes again. I mean, my point is still at the same, that we have specified the types of the trucks. Done. Then C, the customer does have the right to obtain substantially all of the economic benefit from the use of the truck over the contract period, as its good will occupy substantially all the capacity of the truck, thereby preventing other parties from obtaining the economic benefits from the use of the truck. Now, the right to obtain the economic benefit is concerned, this is also meeting up the point as well, that as far as the economic benefits or as far as the capacity of utilizing the truck is concerned, we will be enjoying that, or we will be getting all of the benefits related to as far as from the use of the truck is concerned, we'll be getting that. But again, however, C does not have the right to control the use of the truck, because C does not have the right to direct its use. C does not have the right to direct how and for what purpose the truck is used, how and for what purpose the truck will be used, i.e., the transportation of the specified goods from London to Edinburgh within a specified time frame is predetermined in the contract. C has the same rights regarding the use of the trucks as it were one of many customers transporting the goods using the truck, right? This is what the issue is. I mean, what if from transporting from London to Edinburgh, you have to stop in between at any other particular point where you have to drop your goods? You can't do that because you don't have the right to direct the use. Secondly, you have specific pickup and delivery dates. You have specific pickup and delivery dates. You can't change them as well. So if you can't change them, then technically speaking, this is an issue as well. I mean, if you cannot change the pickup and deliver, the delivery dates, I mean, if you want to do the pickups from later or something, you won't be able to do that. You won't have the right to do that. Nah? So technically, this is something where you are lacking the right to direct the use of the asset. So this is what, or this is the point where it has to be discussed, or it needs to be addressed, because this is not making up a lease. Now, separating components of a contract, there can be a situation where we might have separate components of a contract. For example, for a contract that contains a lease component and additional lease and non-lease components, such as the lease of an asset and the permission of a maintenance service. Lessees shall allocate the consideration payable on the basis of the relevant standalone prices, which shall be estimated if observable prices are not readily available. As a practical expedient, a lessee may elect by class of underlying asset not to separate non-lease component from the lease components, and instead account for all components as a lease. Lessors shall allocate consideration in accordance with IFRS 5 revenue 15 revenue from contracts with customers. So this is a standard revenue from the contracts with the customers is something that we have to study over here. And this whole paragraph, the separating component of a contract, is dealing with the idea that hold on for a second, please. Give me a second. Okay, so as I was saying, the separating components of a contract is the point basically which is dealing with the idea. I mean, you must have heard that this is mostly the case, whereas the US is concerned, normally when we see over there that most of the mobile phone carrier companies basically allowed to have you a cell phone as well. I mean, if you buy a 1 year or 2 year package, you are able to get a cell phone for free as well, or you are able to get the cell phone on the installments as well. So this is a point relating to those specific areas where we are getting a cell phone, obviously, that is on a lease along with the carrier or along with the carrier charges that we might have to pay, or along with the sim basically that we normally pay. So that is the point basically it's discussing over here, as far as when we get a phone on the lease is concerned or on the installments is concerned along with the carrier. So how to account it for as a lease, because as far as the carrier is concerned, we are paying for it on a monthly basis, but for as far as the phone is concerned, we have leased the phone, and now how we are supposed to pay for that. And then as far as the phone companies are concerned, as far as those companies are the lessors now, giving us the phones and then giving us the carrier option as well. Then it's talking about those basically how to account it for. So basically, this is the point which is explicitly dealt with in IFRS 15. That is the revenue. So we will be discussing this point over there. Now, accounting for leases, we have talked about how to account for, or what are the points that we have to keep in mind. So we just came across two crucial points. One is the right to direct the use of the asset, and then the second one is the identified asset. If we have an identified asset and if we have the right to direct the use of the asset, then in this case we can record it as a lease. Otherwise, we are not allowed to record it as a lease. So let's just assume that we have an identified asset and we have the right to direct the use of the asset. We have an identified asset and we have the right to direct the use of the asset. Now, what to do as far as the accounting treatment is concerned? Because at the end of the day, we have to talk about the accounts that we are preparing, and how to account for them. Now, as far as the recording is concerned, the right of use asset would include the following amounts where relevant. As far as recording the asset is concerned, we have to include these amounts. Any payments made to the lessor at or before the commencement date of the lease. Any payments that we have made to the lessor less any lease incentives received. Any because of the lease we have received any incentive from the lessor, that is going to be deducted from the amount that we have paid as far as for the lease is concerned. So this is the amount that's in case we are doing a payment of like 100,000, and as an incentive the supplier has refunded us 5,000 or something, or gave us the 5,000 as a cash back something. So that 5,000 is going to be deducted from the 100,000, and we are going to only have the cost of 95,000 as far as for the asset is concerned. And this lease incentive, it will be straight away explicitly written in the question if there is any. So any payments that we made to the lessor, they are going to be added in the cost of the asset, and we have to deduct the any incentive being received. Then any initial direct cost incurred by the lessee. We have incurred any initial direct cost as far as like, to get the lease asset and all, that is going to be added into the cost of the asset. For example, any legal cost or any acquisition cost or something that we have incurred or something, or we are incurring or something, that is going to be capitalized as well. Then an estimated of any cost to be incurred by the lessee in dismantling and removing the underlying asset or restoring the site on which it is located, unless the costs are incurred to produce inventories, in which case they would be accounted for in accordance with IS2. Costs of this nature are recognized only when an entity incurs an obligation for them. Okay. Now, you made any payment to the lessor, you deducted any incentive being received. Then any initial direct cost that you have incurred in the name of the legal or something, that's going to be capitalized as well. Then if there is any future dismantling or site restoration costs that you might have to incur at the end of the use of the asset's life, then that will be capitalized as well according to the rules of IS 16, which we have already discussed and talked, that any future dismantling cost or something has to be capitalized as far as the cost of the asset is concerned, and that is normally capitalized. I mean, when the present value of that future dismantling cost is capitalized along with a corresponding liability. Done. So this is something that we are going to capitalize as far as the cost of the assets are concerned. Then we have the depreciation. Now, the depreciation is going to be on a straight line basis, but the interesting thing is when it comes towards the life of the asset. Now, look at this point. The right of use asset is subsequently depreciated. Depreciation is over the shorter of the useful life of the asset or and the lease term, unless the title to the asset transfers at the end of the lease term, in which the case the depreciation is over the useful life. Now, this is a very interesting point. If the title of the asset is going to be transferred to you at the end of the life, if the title of the asset is going to be transferred at your name at the end of the life of the asset, then that leased asset should be depreciated over its useful life. Done. If at the end of the lease you are going to get the entitlement of the asset, then the asset should be depreciated over its useful life. Otherwise, it will be depreciated over the shorter of the asset's life or the lease term. Normally, it is the lease term that we have and we normally depreciate, because normally it is the lease term which is the shorter of the asset's life or the lease itself. So we are going to account it for, or we are going to depreciate it over that particular period. Practically speaking, the lease term is normally shorter than the asset's life. Then we have the lease liability. Lease liability is effectively treated as a financial liability, which is measured at amortized cost using the rate of interest implicit in the lease as the effective interest rate. So, as far as the liability is concerned, this is going to be recorded as at the amortized cost. And normally speaking, this is the present value of the future lease payments as well. I mean, we recorded this over here, the right of use assets. So this is the present value which we have calculated. So this is going to be recorded into the lease liability. Now, example, accounting for the leases. A lessee enters into a 20-year lease of one floor of a building with an option to extend for a further 5 years. Now, see this point. We have entered for a 20-year lease and we have an option to extend the life. Remember how to calculate the useful life? I mean, to account for the extension period as well into the useful life of the asset if there's a probability that you are going to avail it. Lease payments are 80,000 per year during the initial term and 100,000 per year during the optional period, all payable at the end of each year. To obtain the lease, the lessee incurred initial direct cost of 25,000. This initial direct cost to be capitalized in the cost of the asset. Now, at the commencement date, the lessee concluded that it is not reasonably certain to exercise the option to extend the lease. This option of extension 5 years. So he got that for 20 years. He had an option for the extension of 5 years, but at the inception, at the commencement, he's not reasonably certain that either he's going to go for the extension or not. And therefore, determined that the lease is 20 years. The lease term is 20 years. The interest rate in the lease is at 6%. The present value of the lease payments is 917,600. So if we calculate the 917,600, this is the amount that we are going to pay over the 6 years. At the commencement date, the lessee incurs their initial direct costs and measure the lease liability at 917,600. Right? The lessee incurs the initial direct cost and measure the lease liability at 917,600. The carrying amount of the right of the use asset after these entries is 942. How 942? 917,600 is the present value plus this 25,000, the initial direct cost, because this is something that has to be recorded in the accounts, right? Remember, we read over here that as far as the cost is concerned, this cost regarding the asset, any initial direct cost incurred by the lessee, these are the ones that have to be capitalized, right? I mean, talking about this point over here, let me just do the or write up the double entries for you guys. We are going to debit the asset with 917,600. We are going to credit obligation under lease at 917,600. Then debit asset with 25,000. The recording. This is how basically it's. Okay, I'm sorry, got disconnected for a second. So the asset will be reported at 917,600 plus 25,000 is 942,600. Done. So this is how the asset is going to be reported. So at commencement date, the lessee incurs the initial direct cost of measure the lease liability at 917,600, and consequently the annual depreciation charge will be 47,130. This is 47,130. Now, how is this? This is basically at 20 years is the life, right? So 942 by 20 years, this is 47,130. The lease liability will be measured using the amortized cost principles. In order to help us with the example in the following section, we will measure the lease liability up to and including the end of year 2. This is done in the following table, this table over here. As far as this table is concerned, let me take you to the Excel in order to make you guys understand that how the table is basically working. I'm just making up the table over here because I remember last time when I had a chat with you guys were the ones basically, like, having read the standard in your graduation basically. So I'll be guiding you a bit over here regarding the schedule again. Okay, let me just share my Excel and let me just, okay. First, present value of lease payments is 917,600. Lease term is for 20 years. Discount rate is 6%. Yep. And if you remember, it is written in the question. I'm just looking at the question. Okay. Lease rental are 80,000 per year, payable in arrears. Done. So this is the half where it is talking about the liabilities as far as for the asset value to be capitalized is 942,600. Life is 20 years. So you are going to have the depreciation charge over here. Now let's just talk about this liability portion. Basically, for the IAS 1 presentation of financial statements, it requires the liability to be split among the current and non-current portion. So we are going to make up a lease schedule. We are going to make up a lease schedule, and this lease schedule is going to be for payment in arrears. So we have number of years, liability at start, then we have interest rate, then we have total, then we have repayment, and then we have liability at year end. So this is the one normally we make when the payments are made in arrears. Okay, now we have year one. Liability at start is 917,600. Interest rate or the discount rate in the lease is 6%. So this into 0.06, we have 55,056. The total is going to be the sum of these two. $972,856. Then we have the lease rental of 80,000 per year. And then we have a liability at year end of The sum of these two are 892, 656. Done. And then we have for year 2, this is going to be this amount, because the liability at the end of year 1 is the one we are going to have a start with the year 2. So this is going to be 892. Then we are going to have the interest over here in the same way that we have over here, that we are going to take the 6% of this 892, and then the total is going to be the same way that this is going to be the sum of these two. Then we have the repayment, we are going to have it over here, and then this is going to be the total 942,615 minus 80,000. This is going to be at 866,215. Done. Now, as far as the end of year 1 is concerned, what will happen? Basically, we have non-current liability. We can write right of use asset, or we can write obligation and a lease. It's your choice, whatever you want to write. Okay. Now, if you look over here at the end of year 1, we have a total liability of 892,656. That is the total amount that is to be paid at the end of year 1. Then total amount, which is payable or which is left to pay. Now, if you look at the end of year 2, we are left with this 866,215. That is the amount which is still left after 1 year. So technically speaking, this is going to be our non-current liability, and that is 866,215. Done. This is the amount that is still left with us that we have to pay at the end of year 1. And if we take the difference of these two, that is the amount that will be paid in the coming year. So 892,656 minus 866, we get 26,441. This 26,441 is going to be our current liability. This 26,441 is going to be our current liability that we are going to report at the end of this current year. Now, if you don't get this, let me show you it the other way. What are the lease rentals? You tell me. These are the lease rentals, and these are the payments that we will have to do, right? So the total is 80,000. This 80,000 that we are doing, right? Every year this is going to be fixed. Now, when we are paying this 80,000 every year, what is the actual breakup of this amount? What is the actual breakup of this amount? I mean, this 80,000 that we are paying, how is the breakup of this amount being made? Actually, the breakup is simple, that we are going to pay the interest with this amount, obviously, and the portion of capital repayment is going to be there as well. We have to pay the interest, and then the portion of capital repayment is going to be there as well. Now you look and tell me that in year 2, this is the end of year 1. So technically the next year we are talking about. In year 2, how much interest are you paying? You are paying interest of 53559. Done. You are paying interest of 53559. You are standing at the end of year 1. Done. You are standing at the end of year 1, and you are looking in year 2, and you are saying that, okay, in year 2 I'll be paying this 80,000, and in this 80,000 I'll be paying an interest of 53559. Done. If the total amount is 80,000 and you are paying 53559 as interest, what is the capital repayment? This is 80,000 minus 5353559. Now check the magic. 26,441, the same amount that we have over here. The difference of these two. That from 892,656, you are left with 866,215. Similarly, if you go for the end of year 2, look here, if you go for the end of year 2, you will need to have an extra of another year, that is the year 3. So this 866,215, interest of this amount over here, total here, repayment is again the same. So you will have this 838,188. Now at the end of year 2, as far as this non-current liability is concerned, right of use asset, this is simple. The right of use asset basically at this point for the non-current liability portion is basically this 838,188. 838,188. Done. As far as the current liability is concerned, how is it going to be done? Now look here, again the same concept. Either you can take the difference of these two, this is 28, oops, this should be G17 minus G18, 28,027. Okay, the difference of these two, 28,027. Otherwise you can look over here again, that 80,000 is total. How much are you paying the interest in the year 3? This is 51,973. Take the difference, 28,027 as the capital, current liability. So you will keep on going for the 20 years. So you will keep on going for 20 years like this. Done. And you will have the balances like this. You will have the interest like this, the total like this. Now I'm just going to show you one interesting thing. This 80,000 is here. Now look here, what will happen. See, in a 20, you will be left only with the 20. This is because of the rounding off and all. Otherwise, look here, the you must have seen, or you must have at times looked at getting the finance of your car or some other asset from the bank is concerned. So normally this is the schedule which they make as far as calling it as your payment plan is concerned, and they give you this payment plan according to which we have to go. You have to go basically as far as for the payments is concerned. So this is the working at the back end, which is normally over there as far as for the payments are concerned. So I made this schedule which is being called as for the payment scenarios. Now let's just talk about a lease schedule for advance payments. Normally it is the same. We are going to have number of years, then we are going to have liability at start, and going to have a repayment here. Then we are going to have a revised balance. Then we are going to have the interest, and then we are going to have the total column. So this is the difference basically, you can say, as the two schedules, that basically you have this repayment in the start, this repayment is over here, and this interest thing is over here. So interest and repayments, they are changed with each other. So this repayment is here and the interest is here, because of which this is called as the schedule for the payments in advance. Done. I hope it's clear to you guys. I mean, this is the schedule that we might come across, like, while studying, and we will discuss it again in detail once we go over there. So this is a schedule which is being made, and this is obviously the finance cost that we are paying. 55056 is going to be the interest cost or in our finance cost in the statement of comprehensive income, and this is the liability that we have at the end of the day. Now, this is again the explanation. Let's just leave it because we have already done that. The points to remember, the points which we have to keep in our mind. Upon lease commencement, a lessee recognizes a right of use asset and a lease liability. The way we recorded an asset and we recorded a corresponding liability. The right of use asset is initially measured at the amount of the lease liability plus any initial direct cost incurred by the lessee. Adjustments may also be required for the lease incentives, payments at or prior to commencement, and restoration obligations or similar. And talking about this, basically, as far as the cost of the asset is concerned, we capitalize the initial cost or the direct cost. Along with that, if we have paid any cost of acquisition of the asset that we have got under the lease, we are going to capitalize that as well. Then if any incentives are received or whatsoever from the lessor or something, then they will be deducted from here. Then they will be deducted from here. We will deduct those from here. Okay. Then it says after lease commencement, when the lease is started, a lessee shall measure the right of use asset using the cost model. We will measure the right of use asset using the cost model. We measure it at the cost model. So technically talking about measuring at the cost model means that we have to calculate the depreciation and then we have to calculate the carrying value of the asset. Done. Unless the right of use asset is an investment property and the lessee uses the fair values, it's a investment property under the IS 40. I mean, if we have gotten a property and we have classified it as an investment property and we have used the fair value model, then we can, like, go on to use it into the under IS 40. I mean, if you remember the investment property, it was any investment being made into the real estate properties. Basically, for example, if you get a house, building, flat, or a piece of land on installments, then that's the investment property. And in that case, rather than going for the cost model, you value your asset under the fair value model. Done. Or the right of use asset relates to a class of property, plant, and equipment to which the lessee applies IS 16's revaluation model, in which case all the right of use asset relating to that class of property, plant, and equipment can be revalued. Or it can be a case that where you have gotten an asset and you are already using the fair value model on that particular class of asset. So technically, when you get this asset under the fair value option, you are going to apply the fair value model on this asset as well. So the point, let's just recap and recatch whatever we have just talked about. We have got the asset under the lease, done, under the right of the lease asset. We are going to measure our asset at its initial cost plus any direct cost paid as far as the acquisition of the asset is concerned, minus any incentive received. Done? We have calculated the cost. Now, as far as the asset is concerned, we will measure it onto the cost model, the default category. Unless the leased asset is an investment property, if the leased asset is an investment property, we will have to use the fair value model with the changes taken to income statement. Or the asset you have leased, the category of those assets are measured by you according to the fair value model already. You are using the fair value model on that category of asset. So technically, if you are using the fair value model on that category, then you will have to obviously measure this new asset onto the fair value as well. Done? So this is what you have to do. Then under the cost model, a right of use asset is measured at cost less accumulated depreciation and less accumulated impairment. I mean, if you have any, what do we say, as using the cost, if you're using the cost model, then obviously you will have to deduct the accumulated depreciation and accumulated impairment, obviously. And as far as the lease liability is concerned, the lease liability is initially measured at the present value of lease payments payable over the lease term, discounted at the rate implicit in the lease, if that can be readily determined. If the rate cannot be readily determined, the lessee shall use the incremental borrowing rate. If you are able to get the rate implicit in the lease, then you are going to use that. If you are unable to get that rate, then obviously the incremental borrowing rate which you are using, you are going to use that. Done? So this is what you are going to have. Now, one more interesting thing which we come across over here, and that is we might or we can have variable lease payments. Variable lease payments are the payments that depend on an index or a rate, are included in the initial measurement of the lease liability and are initially measured using the index or rate as at the commencement date. Amounts expected to be payable by the lessee under residual value guarantees are also included. I mean, there can be a situation where you are paying a variable rate according to the changes in the interest rates and all. If the interest rate changes, then obviously your payments are varied, and then you pay according to those. So variable lease payments that are not included in the measurement of the lease liability are recognized in the profit and loss in the period in which the event or condition that triggered the payments occur, unless the costs are included in the carrying amount of another asset under another standard. So again, this point is something a bit tricky to understand, but let's just take the logic behind it. The variable lease payments, obviously, which you have to do over the lease term, if they are not included in the measurement of the lease liability, when you calculate the present value of the lease liability and you have not recorded those, then they are going to be recognized in the profit and loss in which the event or condition that triggers the payment, right? I mean, if you calculated the present value of the lease liability and you did not accounted for the variable portion element or something, and now because of the index difference or something, you have to pay an additional amount. That additional amount is going to be charged into the income statement as an expense. Because if at first, let's just apart from this, I'm just telling you for the sake of example. For example, you bought some goods from a foreign country, and when you bought, the exchange rates were lower. Now when it came to the payment, you have to pay a bit extra because of the higher exchange rate. And because of the higher exchange rate, when you are paying extra, the over and above amount is charged in the profit and loss account as an expense, as a loss on exchange rate. Now, similarly, in the same context, if you did not account for the variable changes in the lease payments, and then afterwards if you have to pay extra, that extra is going to be recorded in the statement of comprehensive income as the balancing figure. Then that is going to be recorded over there. And talking about, unless the costs are included in the carrying amount of another asset under another standard. For example, if we are carrying that particular difference under any other asset, then that is going to be recorded over there. The lease liability is subsequently measured to reflect the changes in the lease term, that is using a revised discount rate. The assessment of a purchase option, I mean, if we have a purchase option or something, and the amounts expected to be payable under the residual value guarantees using an unchanged discount rate, or future lease payments resulting from a change in an index or a rate used to determine those payments. So basically, in order to remeasure the liability from the theoretical point of view, I mean, we have these points. And obviously, if we are changing some lease terms or something, or we are incorporating the purchase options into the lease or something, that is why we have to recalculate the lease liabilities at all. Otherwise we don't have to, right? Now, as far as the exemptions are concerned, or the lease exemptions are concerned, the lease for the shorter term or the low value leases, for those we have an exemption in the accounts, right? If the lease is for a shorter term, or the lease is for a low value asset, or the lease is for a low value asset, then in that case what we do basically, we can avoid towards recording those leases is concerned. I mean, we are allowed with an exception. Now, instead of applying the recognition requirements of IFRS 16 described above, a lessee may elect to account for lease payments as an expense on a straight line basis over the lease term, or another systematic basis for the following two types of lease. Number one, leases with a lease term of 12 months or less and containing no purchase option. This selection is made by the class of underlying asset. I mean, if you have an underlying asset and you're leasing it for like 12 months or so, and there's no purchase option or something, then in that case, the lease is going to be recorded. You will, you don't have to record the lease as far as into a proper right of use asset is concerned. Then leases where the underlying asset has a low value, when such when new talking about the leases under the where the underlying asset has a low value, when you buy something and that has a low value, for example, computer or small items of office furniture, this selection can be made on a lease by lease basis. For example, if you're buying an asset and that asset when compared with the other assets has a low value, then in that case you can avoid to record it as a lease. For example, like you have multiple non-current assets reporting being reported at millions in your statement of financial position. You go and get a laptop or a computer on a lease, right? Comparing the value of a laptop with the value of a building or with the value of a plant and machinery, obviously that value is really very low, right? That value is really very low. So in that case, rather than like, we have the concept of the materiality, and yeah, we have the concept of the materiality over here, that we don't have to report such transactions onto the face of the financial position because they are not material. So we are allowed with an edge to report those such payments. Done. So we can have like, we can have those into like, we can charge the rental of those assets in straight away into the comprehensive income. For example, like buying the small office equipment or buying the small like, computers or something, laptops, or even talking about the telephones as well. So these are the one which are the assets with a low value. Now, before we move ahead towards the sale and lease back, let me just take you to our next question that was for the leases. And yeah, this is the question which we had for the leases. And this is something which we are going to discuss now. And talking about this first one, basically, this is a sugar company leased a machine from Spice Company. This is a sugar company and spice company that we are discussing now, or we are about to discuss. And okay, sugar company leased a machine from Spice Company. The terms of the lease are as follows. Inception of lease is on 1st January. Lease term is for 4 years at 78,864 per annum, payable in arrears. Present value of future lease payments is 250,000. Useful life is 4 years. Done. The lease term is also 4 years. The useful life of the asset is also 4 years. Now, requirement A. Calculate the interest rate implicit in the lease using the table below. This is the table we have, and this table shows the cumulative present value of $1 per annum, receivable or payable at the end of each year for n years. 6, 8, 8, 10%, we have the number of years. And we have to calculate as far as the interest rate in the lease is concerned. Now, talking about this interest rate in the lease, as far as this lease is concerned, this is very logical one, and that is, it says present value of future lease payments. Future lease payments. Talking about the present value for the future lease payments. So basically, it is hinting us a formula which we have read in the financial management, and that is of the present value of the not of the perpetuity, but the present value of the annuity. So that is the present value of the future lease payments is equal to cash flows into annuity factor. If you look over here, the present value of the future lease payments is 250,000. That is equal to cash flow is 78,864 into annuity factor. Now, we don't have the annuity factor or the discount rate with us, but we do know the other figures, that is 250,000 by 78,864, which you solve, you will get 250,000 by 78,864, that is 3.17. 3.1700. Now we have to see, this is 3.4, this is 3.3, 3.17. This is the annuity factor, or the discount rate is going to be 10% for 4 years. See, this from here, and then this 3.170. So this is here as well. Done. So this is something which we just calculated. Now, in part B, it's asking that explain with suitable workings and extracts from the financial statements how sugar company should account for the lease for the years for the year ended 31st December 2021. Notes to the accounts are not required. So we got this lease, and now we have to show that how it is going to be shown in the accounts. Okay. Present value of the future lease payments is 250,000. So we are going to debit the asset with 250,000. We are going to credit write off use asset at 250,000. Then let's just insert a table over here. Okay, we have extract of statement of comprehensive income, extract of statement of financial position over here. Now, as far as the year end is concerned, 250,000 by 4, we get the depreciation charge of what? 250,000 by 4 is 62,500. So we are going to have a depreciation expense of 62,500. Asset is going to be reported. 250,000 minus 62,500 is 187,500. Then as far as this right of use asset is concerned, we are again going to have a table, and this is going to go with, okay, this is going to be number of years, liability at start, payable in arrears, interest, total liability at year end. 1, 2. Liability at start is 250,000. Interest is at 10%. So we have this at 25,000. This is going to be 275,000. Then we have repayment as well. And over here, 78,864. 78,864 are the repayments. So we are going to have liability at year end of 196, 136, and then 196, 136. Interest on this is going to be 19614. So we are going to have 215,750. we have prepayment of 78,864. So we have 136,886. Now, for year one, we are going to have interest expense. In year one, we are paying interest expense of 25,000. Then we have non-current liability, right of use asset, and we have this 136,886 over here. Then we have current liability, right of use asset, and the difference of these two, 196,136 minus 136,886, that is 59,250. Here we go. We don't have to represent these with the negative figures, the liabilities. This was 136. Okay, so this is how basically we are going to have this working as far as the reporting of these is concerned. I hope it's clear to you guys. Done? Okay, so this is the working that we had to do for as far as this requirement is concerned, that explained with the suitable workings, that how we were supposed to do this. Moving ahead from here, now we have a question related to the sale and lease back. And before going to this question, we have to go back to the notes in order to check for this a bit theoretical area, and that is the sale and lease back transaction. Talking about the sale and leaseback transaction, the treatment of sale and leaseback transactions depends on whether or not the sale constitutes the satisfaction of a relevant performance obligation under IFRS 15 revenue from contracts with customers. The relevant performance obligation would be effective transfer of the asset to the lessor by the previous owner, now the lessee. So basically in the sale and lease back, we have to check that either the recognition criteria of the sale is met or not. Transaction constituting a sale, if the transaction does constitute sale under IFRS 15, then the treatment is as follows. The seller, that is the lessee, shall recognize only the amount of any gain or loss that relates to the rights transferred to the buyer lessor. The buyer shall account for the purchase of the asset by applying the applicable standard, and for the lease applying the lesser accounting requirements in IFRS 16, right? Technically, when the right of use asset is to be applied, that is the lease is to be applied, where we have a sale and lease back of the transaction, then obviously the lessee who has just sold the asset is only going to record the profit up to the extent that it has achieved as far as for the sale is concerned. And if it's a loss, obviously the loss will be recorded. As far as the lessor is concerned, he has to go for accounting the IFRS 16 is concerned, because he has leased the asset to the lessee. So if the fair value of the consideration for the sale of an asset does not equal to the fair value of the asset, or if the payments for the lease are not at market rates, an entity shall make the following adjustments to measure the sale proceeds at fair value. Any below market terms shall be accounted for as a prepayment of lease payments, and any above market terms shall be accounted for as additional financing financing provided by the buyer to the seller. That's from the lessee to the lessee. Now we have an example of a sale and lease back over here as well. Entity X sells a building to entity Y for a cash of 5 million. Immediately before the transaction, the carrying amount of the building in the financial statements of X was 3.5 million. At the same time, X enters into a contract with Y for the right of use building for 20 years with the annual payments of 200,000 payable at the end of each year. The terms and the conditions of the transactions are such that the transfer of the building by X satisfies the requirements for determining when a performance obligation is satisfied under IFRS 15. X and Y account for the transaction as sale and leaseback. The fair value of the building at the date of the sale is 4.5 million because the consideration for the sale of building is not at fair value. Now look here. The building was carried at 3.5 million, the carrying value. It was sold for 5 million, whereas the fair value was 4.5 million. So the consideration involved is basically not at the fair value, which is at 4.5 million, but the building sold for 5 million. So the X and Y make adjustments to measure the sale proceeds at the fair value. Now, the amount of the excess sale price of 500,000 is recognized as additional financing provided by Y to X. The annual interest rate implicit is 5%. The present value of annual lease payment 20 years of 200,000 discounted at 5% amounts to 249 to 400, of which 500,000 relates to additional financing and 1992 relates to the lease. The annual payments that would be required to make 20 payments in areas to repay the additional financing of 500,000 when the rate of interest is 5% would be 40,122. Right? This 12.42 is the cumulative discount factor for 20 years. Therefore, the result will be regarded as a lease rental at an amount of 159,878. Done? Now, this is something where we have to do an adjustment where the over and above amount is where you have to adjust for the financing. Where the over and above amount is for the financing. This is what basically you have to adjust. Done? So this is something where we will have to pause for today, the sale and lease back. Now, I'm giving you a homework, and that is first you have to go through this whole standard. Then I have shared, let me go back to the question. This exam kit, this is from the Kaplan exam kit, the sale and lease back part. This part along with, this is something I will do over here in the class. You don't have to do question 29. I will do it myself over here in the class, because this is something which requires explanation with the aid of the ratios and all. This is something I will do. All you have to do is you have to write down an answer about what do you think about the application of the lease as far as this standard is concerned. As far as the application of the standard is concerned regarding the lease, you have to write down the same way we discussed in the morning regarding what are you supposed to do as far as reporting or writing about a standard is concerned. I mean, in the same way, like you can say that in the morning when we discussed about the IAS 16, how we started off with the standard, how we talked about the recognition criteria and all. So this is what I'm expecting from you guys about this. You have to write down about what do you know about the lease and what should be the accounting treatment and all. And this is something which is like, you have to reproduce over here. Try to do that so that I may get an idea about how you are approaching towards the answer of the question, so that if there are any amendments or there is anything that I have to update, regarding your answers and all, I can do that in a timely fashion, so that you can, like, set your approach. And eventually we have to prepare for the paper. Obviously, at the end of the day, that is what the approach we have over here. So try to solve this question and try to send me onto the WhatsApp if you are done, early with the question. Otherwise, we will have a discussion about this as well in our coming class. Done. So it's all from my side for today. I hope you had a proper understanding of the standard which we discussed over here. And if you have any question or something, you can ask me. Otherwise, we are good to go. Okay, Miss Mary, you are asking about the fair value measurement, basically. Yeah, I did happen to skip that for now because it will be done later. Because when I was going to the fair value measurement, basically we had to involve the consolidation thing into it as well. So that is why I have just paused it, and I will be doing it in the coming lectures, basically. I gave the course outline basically as a tentative one, but basically I am changing a bit stuff in that, because like today as well, basically, if I'm not wrong, we had some other topic as well, like the IS 37 or something, but I hold it on for now, because I'm just I just changed my approach a bit. Obviously, the updated course outline will be given as well, but I had to change my approach just this time, because last time, while covering up the other standards and all, we were kind of left with a bit of a less time with these some important standards. So that's why I am keeping these important standards at the start, where we can have an in-depth analysis and discussion, and then these small standards will come a bit later, where we will be discussing about these. Okay. So that is why the fair value basis and all, it was not discussed. It will be discussed. Obviously, it's not something that we are going to leave or something. But as far as its discussion is concerned, it will come later. Anything else? Any other question or something? Okay. So this is all for today. Take very good care of yourself. Enjoy the whole week ahead of you and the rest of the weekend as well. And till we meet again, it's bye-bye. Take care.